Avidity Biosciences, trading right now at $70.15, which is a massive, massive surge of 42.73% on the day. The volume is astronomical, and the tickers are flying. Now, if you're just logging in to your Fidelity or Robinhood app, you're seeing a wall of green and probably thinking you've just seen the culmination of a long, risky biotech bet. The expectation, seeing a 42% spike, is that a clinical trial hit a spectacular endpoint, but that's not what's happening. The reality is that this isn't a data-driven spike, it's a buyout. And more importantly, the price isn't the real story. The real story is the gap between the $70.15 you see on your screen and the $72 per share cash offer that was just put on the table. That $1.85 difference is where the entire narrative for this stock has shifted, moving it overnight from a high-growth science project to a complex merger arbitrage play. Let's get right into it. The news, which broke over the weekend, is definitive. The Swiss pharmaceutical giant Novartis has entered into an agreement to acquire Avidity Biosciences for approximately $12 billion in cash. The terms are $72 per share. This represents a 46% premium over Friday's closing price of $49.15, which is why we're seeing today's explosive move. The market is simply repricing the stock to reflect this new reality. The expectation for long-term holders was that Avidity science would someday lead to a blockbuster drug. The reality is that Novartis just validated that science in the most emphatic way possible by buying the entire company. For many investors who have been holding this through the volatility, this is the exit they were hoping for. This isn't a gradual climb like you'd see with Apple stock. This is a sudden binary event. But this is where a professional investor's mindset has to differ from a casual one. The average person doing some online investing sees $72 and thinks the stock should be trading at $72, but it's not. It's at $70.15. That discount isn't an error. That gap represents time and risk. The deal isn't expected to close until the first half of 2026. That's a long time to have your capital locked up. An investment sitting stagnant for over a year has an opportunity cost. More importantly, every major acquisition carries regulatory risk. Will the FTC or European regulators approve this deal? The market is saying probably, but not with 100% certainty. That $1.85 discount is the market's price for that uncertainty and that waiting period. So, the question for anyone holding shares in their individual brokerage account is no longer, will the science work, but will the deal close, and is the 2.6% spread worth the wait? So why is Novartis spending $12 billion on Avidity? It's not for their current sales because they don't have any meaningful ones. It's for the platform. Avidity has pioneered what it calls antibody oligonucleotide conjugates, or AOCs. In simple terms, this is a delivery technology. For a long time, RNA-based therapeutics, which can get inside cells and fix problems at the genetic source, have been incredibly difficult to get to the right targets, especially muscle tissue. Avidity's AOC platform acts like a guided missile. It uses a monoclonal antibody, the guided part, to find a specific receptor on muscle cells, and it carries an oligonucleotide, the warhead, or more accurately, the repair kit, directly inside. This technology is designed to treat diseases that were previously considered undruggable. This is what Novartis is buying. They are buying a key to a locked door that much of the industry has been struggling to open. This is a very different kind of value proposition than, say, Nvidia stock, which is valued on its current massive earnings from selling chips. Avidity is valued on the potential of its science. This acquisition brings 3 late-stage, multi-billion-dollar opportunities into the Novartis pipeline. The first is del-desiran, a treatment for myotonic dystrophy type 1. This is a devastating, progressive muscle-wasting disease. Data from Avidity's Marina open-label extension trial was incredibly strong, showing not just a slowing of the disease, but an actual reversal of progression in some patients across key endpoints. This is the kind of data that makes a company a buyout target. Novartis sees this and knows it can put its massive commercial and regulatory muscle behind it, leveraging the ongoing Phase 3 Harbor trial to get it to market. The second asset is Delbrax, which targets facioscapulohumeral dystrophy, or FSHD. Again, this is a condition with no approved treatments. The Phase 1/2 Fortitude trial showed what the company called unprecedented reductions in the DUX4 regulated genes that are the root cause of the disease, along with positive trends in muscle function. The company was already planning an accelerated approval submission, and Novartis will now shepherd that process. The third major candidate is Delzota for Duchenne muscular dystrophy, or DMD, which has also shown promising data in its Explore 44 trial. Novartis isn't just buying 3 drugs, it's buying the entire factory, the AOC platform that can create more of them. This is a strategic move to bolster its neuroscience franchise. But there's another wrinkle for current shareholders, and it's a critical one. It's not just a simple cash-for-stock swap. As part of the agreement, Avidity will first separate its early-stage precision cardiology programs into a new independent, publicly traded company, which they are calling SpinCo for now. Before the Novartis acquisition closes, Avidity shareholders will receive 1 share of this new SpinCo for every 10 shares of Avidity they own. This means the total value of the deal is actually $72 in cash plus this new speculative share. This complicates the arbitrage math. How much is that SpinCo share worth? Nobody knows. It's a high-risk, early-stage asset. This is a classic spin-out designed to keep the main deal clean for Novartis, which wants the muscle disease assets, while still giving existing shareholders ownership of the moonshot cardiology projects. This changes the entire trading dynamic today. The volume we're seeing is a complete shift in the shareholder base. All the long-term biotech funds and retail believers who held for the science are now hitting the sell button on their Fidelity trading platform or SoFi Invest app, taking their 42% one-day gain and moving on. And who is buying from them at $70.15? The merger arbitrage desks. These are specialized hedge funds and institutional players who use platforms like Interactive Brokers for their complex trades. They are buying the stock at $70.15, and their entire thesis is to hold it until the deal closes in 2026, at which point they will receive $72 in cash. They're calculating their annualized return on that $1.85 spread and weighing it against the regulatory risk. This is a trade for professionals. This is not the kind of investment help you get from a robo-advisor like Schwab Intelligent Portfolios. This is an active, event-driven strategy. So what's the expectation versus reality now? The new expectation is that this is a done deal and a safe place to park capital for a small, predictable return. The reality is that it's mostly a done deal, but that small discount exists for a reason. We've seen deals break before. Regulatory bodies, especially the FTC, have become much more aggressive in challenging pharma and tech mergers. If for any reason this deal were to be challenged and subsequently fail, Avidity stock would not drift down calmly. It would collapse instantly all the way back to its $49.15 price or possibly even lower as all the arbitrage money flees. That is the risk you are taking by holding for that $1.85. The high-volume trading on Robinhood today is likely a mix of people who don't understand this risk and are buying, and people who are very happy to sell to them and lock in their profits. This is a massive event for Avidity holders, and it completely changes the calculus for everyone involved. The company's story is no longer its own. It's now a subsidiary in waiting for Novartis. The narrative is no longer about if the science will be valued, but when the check will clear. This is the end game for a successful clinical stage biotech. They didn't have to face the long, costly battle of commercialization alone. They didn't have to dilute shareholders again and again to fund phase 3 trials and sales teams. They proved the platform, got to late-stage data, and a giant came in and validated their entire thesis with a $12 billion offer. It's a textbook execution. This is such a specific, event-driven moment for the stock, and everyone's situation is different. I want to know what you're doing. Comment below. Are you selling today to lock in the gains and move on to the next opportunity, or are you holding until 2026 to capture that last bit of arbitrage spread and get those new SpinCo shares? So to summarize where we are, the expectation for Avidity was always that of a high-risk, speculative biotech. It was a binary bet on its AOC platform. Today, that bet has paid off. The reality is that the company is being acquired for $72 per share, which has sent the stock soaring 42% to $70.15. But this creates a new, more subtle conflict between expectation and reality. The new expectation is that it's an easy, safe 2.6% return. The reality is it's a complex arbitrage trade with capital locked up for over a year and a non-zero risk of regulatory failure. The story of Avidity Sciences is over. The story of its acquisition mechanics has just begun.